Welcome back. You're watching us here on Bazaar Morning Call. A positive start is what the GIFT Nifty is indicating. Yesterday was a pause for breath for the frontline indices. The broader markets did a lot better. But one stock from the frontline pack actually surged in the last hour of trade, and that was Trent. After a big gash from the highs, some brokerages, looking at it positively from a valuation standpoint. Amnish Aggarwal, the Director, Institutional Equities at PL Capital, joins in now. Amnish, good morning. For Trent, what camp are you in? Valuations are now getting supportive after the cut, or do you think they still have, some loopholes that they need to plug before the stock goes back to its all-time high? I think you're on mute, Amnish. If you could, unmute yourself.
Is it fine now?
Yes, perfect. Go ahead.
So, Mangalam, it's very difficult for me to say your stock going to 52-week high or something, but definitely Trent has got, I would say, relatively unique business model in the apparel space. Because first of all, they are not competing online for Zudio. And even for their, you can say the main brand, which is Westside, they are not selling on the other portals. And what they're offering to the consumer is a lot of value in terms of designing, in terms of quality at a certain price. Now, recently, during the analyst interaction also, the company has indicated that its aspiration is to grow at 25%. Now, if you grow at, say, 25% CAGR, I think some bit of, say, operating leverage will also come through, and which will make it one of the fastest growing companies in the consumer stock retail space. Now, if I compare Trent to some of the other names in the consumption space, which might be trading at 50 times, 60 times earnings, so I think the longevity of growth as well as the visibility in Trent remains better than many of the other names. Regarding the valuations, I would say, for example, if I look at, say, Trent and if I look at, say, a stock like, say, DMart, there is very little gap to choose from. But it is the business model which makes Trent slightly superior in comparison to some of the other names in the retail space.
Just to extend that argument, if you're looking at Trent's growth pathway and you're looking at the overall, addressable market, one stock that can be compared in that regard is Nika, because again, it's consumer discretionary. Trent has called out beauty and, fashion as one of the growth paths for the company, as has Nika. If you compare the two, and over the last 3 quarters or 4 quarters, even Nika has outperformed the industry by quite a multiple. Would you look at these two? And in the last 3 months or so, the response in terms of shareholder returns has been identical, 16% higher on both Nika and Trent. Would you compare the two?
You see, I think they are not comparable because Nika they're trying to be omni-channel, but it is predominantly in e-com and you can say e-com-led model. That is one. Secondly, in terms of profitability, there's a sea of difference between the two. For example, you look at, say, Nika. So I would say very, very little profitability is there. So even if, say, I look at Trend today, maybe it might be 70 times plus 2 year forward. But can I have that kind of number for Nika? Very difficult for me to say. Because the gap in terms of, say, few years back, Nika used to be a very unique business model, but today you have got Myntra, who is trying to, you can say, do the same. Okay, even if I don't consider, say, Amazon in the same league, tomorrow you can say, you see the differences today, practically everyone, say, a couple of days back, even Blinkit had you can say, a beauty day, okay, where there were some, maybe, I don't know exactly how many, 40 brands, 30 brands, whatever they might be. So they were also, you can say, giving a lot of discounts and promoting that. So every big e-com player ranging from, say, a big basket, so they are having a beauty, you can say, stack, which is now separate. So that actually reduces the uniqueness which a Nika had, say, a few years back. And that is also getting reflected in the fact that your profitability today is not keeping pace with the top line growth.
Hi, morning. Do you look at Apollo Hospitals at PL? And what have you all made of this planned strategic reorganization of the business, the pharmacy, digital business, all coming together and the eventual listing And it's big numbers, right? 25,000 crore of a top line by FY27, 7% EBITDA margins. What are your thoughts on this move?
You see, Polo as a company, we have been liking this stock, and one of the big drags for Apollo hospitals in the past has been the fact that they have been losing money in 24/7. So they were earlier also clear cut, you can say, guidelines by as to by when the company will look at a, you can say, full turnaround. But I think this demerger actually will be a win-win for all the shareholders, because first of all, you will get to, you can say, get a place separately in the pharmacy retail, which is again a very thriving, very growing area where many of the conventional retailers they are also planning to enter. That is one. And secondly, it also reduces burden on the balance sheet as well as the P&L of Apollo hospitals. So I think from that standpoint, I think very difficult to say whether it will result in any sharp run-up in the immediate term, but in the medium to long term, I think the Apollo hospital continues to be one of the best hospital stocks.
Amnish, you joined us when this deal was announced, but from now, post everything that has come by, what are your thoughts? That's point number one. And today, we also have, JSW Paints and AkzoNobel jointly addressing the press. What is it that you would be looking forward to from them?
Mangalam, can you repeat your first question?
The first question is your thoughts on the paint industry.
Okay, you see, there is as of now no change in our view on the paint stocks. Because, you see, demand, we are also experiencing that the demand should be better this year around. Okay, but will it result in any significant increase in the profitability growth is something which we need to watch out for, because the competitive intensity has increased, the realizations, they remain on the negative side. Yes, there is some cushion which will come for the paint companies because of the benign crude prices, but how much they can hold on to, only time will tell. So we believe that still the valuations are not that cheap. Say for Asian Paints, it might be trading at say 45, 47 times on FY27, unless and until we are factoring in very sharp jump in profitability, which looks slightly difficult to us as of now. Now, as far as your Akzo and JSW is concerned, so I believe that it is not something which is a very, you can say, normal kind of a scenario that now the four players have established, because JSW has always been very aggressive, and you can actually check the filings, how many times they have gone to the regulator, that our distribution is being hampered. There are a lot of, you can say, monopolistic policies which are followed by the market leader. Now, what they lacked was a clearly visible brand on the ground. And what Akzo brings to the table is, I would say, a great brand, but not so aggressive, and I would say very limited work done on the ground. Now, if you combine both these factors, the aggression of JSW plus the brand quality and technology which Akzo possesses, I think that actually, you can say, is a good combination. And while one can say that the current market share might be 10%, so the way JSW Group has expanded in some of the other segments, I don't think that the number three player eventually will be having only 10% market share 2 or 3 years down the line. So I think the war among all these four paint companies is only going to intensify from here as we go along. And that is going to, you can say, check any significant increase in the margins from here. Yes, many paint companies, one might believe they are near the bottom in terms of the valuations, but I think it is early days as yet.
Amnish, let the numbers come in and then we'll discuss the auto sales. But there's also that news about ABS, that's the anti-braking system being potentially mandatory for two-wheelers from 1st of January. The government has released a draft notification, so it's not yet a rule. But if it comes through, it will hurt particularly some of the lower-priced two-wheelers. So say a Hero MotoCorp could be impacted more, and we saw the stock correct. What are you thinking about this issue at PL?
You see, whenever the regulation comes in the auto industry, whether these are emission norms or whether these are, you can say, having these safety norms implemented, it eventually results in an increase in the price of the vehicles, whether two-wheeler or the four-wheeler. Now, the main thing is when you look at, say, two-wheelers in particular, the sensitivity to any such changes is much higher, and that too more at the entry-level segment. Now, once that gets implemented, definitely the companies are going to pass on a major part of the cost increase to the consumers. And this, you can say, a few thousand rupees increase for a big part of the industry volumes. I think it has got the potential to, you can say, depress the volumes at least in the near to medium term.
All right. Talking about monthly updates, I think some of these pipe makers have started giving in their numbers, and APL Apollo will be the big one to track. But I think I saw the bottom of your screen, there was JTL Industries as well that have actually delivered pretty good set of volume numbers. Remember last year, it was lower than what the street was working with. But at least, that first tick that I saw, and as per the press release, they've delivered a 26.5% growth in volumes for the first quarter. And even if you compare the first quarter with the fourth quarter of last year, that as well is up by close to 32%. It has some valuation comfort, but otherwise it didn't really perform in FY25 in comparison to the guidance that was given earlier, though this is a good start to the year. Amnish, any view on these pipe makers? Some of them have done well. They're still a far cry away from all, those 52-week highs. Even the leader, APL Apollo, in the last 2 years has made no money. What's your view on this space?
You see, if you look at the order books, if you look at the overall demand in the economy for all these pipe players, that remains quite strong. Okay, so that is one part of it. So in terms of growth, I think that there doesn't seem to be an issue. However, if you look at, say, the past 3-4 years, all these stocks and APL Apollo in particular, they have seen massive re-rating. And what usually happens is that in all these stocks, when your re-rating then stops at a certain point of time and the P multiples go high, then there is usually a period of, say, sometimes even 1 or 2 years when the stocks go sideways. And I think that is typically what is happening with all these, you can say, APL Apollo and many of these pipe companies. So while the numbers I believe that the numbers will continue to, you can say, come in, the infrastructure, real estate, all these, you can say, construction linked and all these sectors are doing well. So I don't see an issue as far as your growth is concerned, but I think the incremental PE re-rating looks difficult. And that can result in much more consolidation in the stock price before they again start making a move.